Hello, my name is Mikhail Mamonov. I'm an assistant professor of finance at Toulouse Business School. And today I'm going to talk about what happens to firms when they suddenly realize that their banks are actually seen banks and they are detected by the central bank and preemptively closed. This research we initiated with Roman Goncharenko from KU Leuven, Steven Ongena from the University of Zurich, and our former co-authors from the Central Bank of Russia. Over the last year, we all witnessed what happens to banks around the world. What happens to Silicon Valley Bank, First Republican Bank in America, what happened to Credit Suisse in Switzerland, and so on. And those events, they rekindled interests in bank soundness per se. Well, the literature tells us a lot about why this is important, bank soundness and collapses, because those collapses, they entail real implications for the economy, because firms borrowing from those banks, they might suffer difficulties along several dimensions. And the literature consistently tells us that during normal times or during crisis times, what happens to firms? Well, they had to shrink employment, they had to contract investment, and overall they face a reduction in productivity and their market sales collapse. So all in all, negative credit supply shocks lead to negative events for firms. However, what is less known from the literature is that what happens to firms, where do they go after they suddenly realize that they have no lender anymore? And not because the lender itself collapsed, but because the central bank stepped in and said, look, you are a fraudulent bank and I will close you preemptively. So what happens to firms? What is the sorting of firms? Also depending on whether the firms were good firms, bad firms. You can think of profitable firms or firms that suffered losses. And how do those firms find new lenders? Okay, so just to find a good laboratory for this analysis, we appeal to the pre-war Russia, where in 2013, President Putin appointed a new governor of the Central Bank of Russia, Elvira Nabiullina, who is still there. And Nabiullina in 2013 declared a policy intolerant to fraudulent banks. And in 7 years, by 2020, she had closed 700 banks out of 1,000 banks operating before the policy. So 700 banks, mostly small banks, mid-sized banks. And in this environment, just before the war, we have a lot of examples of what happened to firms when they realized that their banks are preemptively closed. We call those banks seen banks. Why? Because those banks were indeed engaged in fraud. If you take their balance sheets, 1 quarter before they were preemptively closed, those balance sheets were looking fantastic. If you compute capital adequacy ratio and average those across all of the banks that were about to be closed, that would be plus 18%, which is still 10 percentage points above the threshold, so it looks fantastically. However, when the banks were closed, central bank introduced a temporary administration to those banks, which revisited all the assets and liabilities. And what they discovered? They discovered that on average, 51% of all assets were not existing. So they had to be charged off, but they weren't. So banks were falsifying their balance sheets. So that the capital adequacy ratio could be re-estimated as minus 51%, which is a lot. That's why we call them seen banks. And if you compute like the ratio of those non-existent loans to GDP, it's gonna be 5%. So 5% of GDP, it's a lot. So in this environment, we investigate the policy. The policy started in 2013 and lasted at least 5 years, when in early 2018, Nabiullina announced that the active phase of the policy is finished. And so within this 5-year period of time, 2013, 2018, we want to understand like what happens to the firms, how they were sorting, how they were matching with new banks, and what happened to their performance. So these are our major research questions. Why this research is also interesting as a kind of another layer of interest in our research is that currently we all discuss sanctions against Russian financial system and Russian economy. And we realized that over 2022, after the full-scale invasion of Ukraine, the West introduced at least 11 packages of sanctions and it seems that they are not that effective still. The Russian banking system over 2022 reported the historically highest levels of profitability, historically after the Soviet Union collapse. So how this can be related? 11 packages of sanctions and banks earning highest profits over its history. All right, so how we can shed light into this problem is that just before the war started, the Russian banking system, the Russian central bank, did a huge work in kind of cleaning the banking sector out of unfair competitors, out of fraudulent banks, and making the system much more resilient to external shocks, if you wish. And what is important here is that also, despite the sanctions that, like the first waves of sanctions in the 2010s, the financial depth, conventionally measured as banking system assets over GDP, increased from 72% to 91% during this massive closure policy of fraudulent banks in Russia, and despite financial sanctions in the 2010s. We start with duration models, where we try to understand what happens to firms, how they find new banks after they realize that their current lenders are closed by the central bank. And here, like, we start our analysis just taking all, like, pulling all the firms that face those problems. And what we realized is that we cannot draw any conclusion. We cannot find any patterns where do those firms go. And like the remedy is that what we are doing, like we realize that firms are different themselves. So if you just distinguish those firms that were profitable on the eve of bank closures, like, let's call them good firms, and firms that suffered losses on the eve of closures, like, let's call them bad banks, then this is where we can find some patterns. And what we find is that actually bad firms, they again try to find a new, not yet detected sin bank. Think of like a staggered implementation of the policy. So they face the closure of their current sin banks, and what they try to do, they try to find another bank which is not yet detected by the central bank. Whereas good firms that for some reason were locked in those sin banks before, now they realize that times change, now they are free, and they are trying to find good banks that, well, at least survive till the end of the sample period. So this is an amazing sorting mechanisms, like when bad firms go to sin banks again, good firms go to good banks. We want to understand why that happened, and we want to understand the mechanisms behind that. So first of all, we start our analysis with investigating the real effects. What happened to firm performance after their current lenders were closed and before they found new lenders. And what we find also amazingly is that actually, like, across all the directions, margins that you can think of, employment, investment, productivity, market sales, what we see is that after banks are closed, good firms, they improve along all those margins. But bad firms, they further deteriorate. They deteriorate a lot, increasing the likelihood of their failure in 2-3 years after detection of sin banks. So this is another interesting finding that we have. And again, we want to understand why that could have happened. And what we do, we just take a step back. Before the banks were closed, we want to understand what was the pricing mechanism of loans. And what we find, using the Russian credit register data, like the universe of all loans issued in Russia between 2013 and 2020, is that we call it credit risk underpricing. So sin banks, before they were closed, what we find is that they were charging, on average, 1.5 percentage points lower interest rate to bad firms. Meaning that bad firms, they were enjoying cheaper loans, which were supporting those operations of the bad firms. And meaning that also symmetrically that good firms, they were suffering from artificially higher loans, high interest rates on loans. And this could prevent them from further expanding. And then, like, when this exogenous mechanism shock happened and the banks were closed, now all good and bad firms, they were on the market, and the market equalized the conditions, the loan conditions that those firms could have. Bad firms, they had to pay higher interest rate on new loans, and good firms, they were able to attract loans at a lower interest rate. And this could shed light on why firm performance of bad firms deteriorated after sin banks collapsed, and why performance of good firms improved after sin banks collapsed. As another mechanism and another interesting pattern in the data, what we observe, we manually collected the data on the bank managers. All the bank managers in 1,000 Russian banks over the last 10 years. Like personal level data stemming from their CVs, so we traced the history of those managers and owners actually, and what we observed, like our idea was that probably bad firms, they try to find another sin bank just because another not yet detected sin bank share the same owner as the sin bank already detected by the regulator. And this is indeed what we found. We found that once we remove all the observations which contain this common ownership problem, then we have no this sorting mechanism anymore. So effectively, in the end of the day, what we show is that answering the main question, quo vadis, where do the firms go, we say that it's very important to realize, to distinguish firms on at least into two groups, broader groups, bad firms and good firms. And what we show is that bad firms, they go to not yet detected sin banks and their performance further deteriorate, whereas good firms now, they realize that times change and they go to good banks and their performance improve.